the reality is China's already peaked from a year-over-year rate of change perspective. And so to answer your question, what you're really looking at is when does the rest of the world peak from a year-over-year rate of change perspective? And more importantly, when does the asset market start to look and price that in? And that to me is that's the $64,000 question.
What is up, you guys? Hamilton here, and I am super excited to share this episode with you. This was a real privilege to be able to interview one of the top macro guys in the world, Darius Dale of 42 Macro. It's important to understand that what you've seen happening in the market these last few days is not a phase transition to a bear market. What matters is what's about to come, and that's what Darius talks about in this interview. If you're an investor, if you have money in the stock market, this is a must watch. Let's do this. Man, I can't believe you're here in person. It's Darius Dale, the absolute legend.
I wouldn't call myself a legend, man. I'm just a fat guy with a computer. How you doing, dude?
Good, man. How are you?
It's a blessing to be here, man. A lot of stuff going on, both publicly and privately, but I'm excited and encouraged by the growth that we've had thus far in the business, and it's been awesome.
I'm excited for you. I've been watching it. I've been stalking it on Twitter and watching your growth. I love it, man. I love entrepreneurship, and I love to see it. Like I've got so much respect for you. You were one of my favorite people, or my favorite person at your old firm, and to see you go out.
Oh, thank you.
Like you deserve to be successful. So I can't wait to see how big it becomes.
Yeah, man, this is only the beginning, man. Like I said, we're working with a lot of really thoughtful investors who want to, I wouldn't call it a better way, but a different way. And what we do is obviously a bit different from what I did in my own firm, but I think it's addressing a real need in the marketplace for thoughtful portfolio construction advice. Obviously blending in the market regimes, the macro regimes, and I think we're on to something. Like the product has been very, very well received, both by the top institutional investors and guys running RA money and guys trading their own PAs. So it's awesome.
It's on my to-do list to sign up for the paid version. So as soon as I get off of this, I'm signing up. You can count on me as a customer.
Well, I appreciate that, man. I'm obviously biased, but I certainly don't think you can spend a better, I don't know, I think it's $180 a month to get all three of our products.
Yeah.
If you're investing at all, I think you should definitely be paying $180 for that. You're not going to find a better value in finance, in my opinion, but I'm obviously biased.
Absolutely. Yeah. So, I mean, thank you so much for coming on the channel, and I really appreciate it. It's so great to have someone of your caliber on here.
And thank you, man. It means a lot.
It's just fantastic. So thank you. For viewers at home that don't know who you are, would you mind just giving them a bit of your background?
Yeah, absolutely. So my name is Darius Dale. I'm the founder and CEO of 42 Macro. 42 Macro is an investment research sort of platform where we really focus on measuring and mapping the economy and using those forecasts to sort of identify the appropriate asset allocations and portfolio construction that we want to have in accordance with those views. We basically want to help investors eliminate bad outcomes from their portfolio by being really good on the forecasting of the economy, by being really good on the back testing of asset markets, and ultimately being really good on the construction of all that information into very specific, very actionable portfolio construction advice. It's sort of a soup to nuts, if you will, process that helps investors really become very dangerous with macro. I think a lot of investors leave macro out there as this thing that they can't control. But the reality is, if you have a repeatable, quantitatively oriented process, you can actually not only control it, but you can actually become very dangerous with it. Certainly what we've observed in the last, I would say certainly since the GFC, but you can make the case that it was starting to, the regime was starting to shift just prior to the GFC, which is, we've been in this regime where most of the alpha that is generated in your portfolio is really being generated at the macro level. What asset classes are you in? What sectors are you in? What style factors are you in? So much less alpha is actually being construed to security selection, which is what most of the buy side is employed to do. So, it's kind of a new dawn, if you will, a new opportunity set for those of us who have macro investing as a skill set and as a background. And ultimately what we're trying to do with 42 Macro is really take my institutional knowledge of institutional macro risk management and really spread it throughout the masses.
So as part of your products, are you going to be advising people on what allocations to make to sector-based ETFs, or are you going to focus on equities as well?
Yeah, so it's the whole gamut. At 42 Macro, we think about breaking down the investing universe into four primary asset classes, the liquid asset classes. You got your equities, you have your commodities, those are similar type return profiles. And then you have your fixed income and your foreign exchange, and those are similar return profiles from an absolute return perspective. So the goal is twofold. How much of each of those asset classes should we be invested in? And then once we understand how much of each of those asset classes we should be invested in, what are the actual exposures within those asset classes that will give us a balanced, sort of highest risk reward portfolio construction setup? So how does it, what we do, what we specialize in at 42 Macro is how that all comes together quantitatively.
Yeah. So let's talk about what's happened in the last year. And then what I really want to get into talking to you about is where you see the market going in the near term to medium term over the next couple of quarters, because I've seen hints of it already on Twitter.
Yeah.
But I think it's important for the rest of the world to know, and any viewers watching this that are investing their own money to be in the loop. So should we take it back to kind of Feb times, because you were calling for a correction in the market probably in around November 2019, or was it earlier?
Yeah, no, I think so when I was working with Hedgeye, our view on the market shifted to negative, what Hedgeye calls quad 4, back at the end of January of 2020. If you look at the compendium of signals that Keith calls the CEO of Hedgeye, look at the compendium of signals that he was looking at in his risk model, those effectively transitioned to, effectively quad 4, by the end of January. So, we were making we were sounding the alarm bell, at least prior to the U.S. equity swoosh, to really head for Dodge and for prices to really start to move to the side and raise cash. So that was kind of the first part of the move is don't get blown up in the drawdown. And the second part of the movie is, okay, when do you get back in? When do you start to reallocate to the upside?
And then around March 19th, 2020, we had this shift to growth and inflation period. And was that all to do with J Powell money printing, or are there other factors we need to take into account?
Yeah, there's a million different factors you need to take into account, and it's our job to probability weight the ones that, and we have the most forecasting validity in terms of predicting, and secondarily, which ones are more valuable. What can we gain edge on, and then more importantly, what are we gaining edge at things that are actually relevant to predicting asset market returns? The answer is obviously yes. So, if I could rewind the playbook on that whole process, J Powell, the Fed came out early March and started to cut interest rates, obviously emergency rate cuts, and then by the end of March, certainly March 23rd, I believe, they announced their expansionary liquidity programs, the credit easing program. They had several secondary and primary credit market programs that really were designed to be a backstop liquidity buffer for corporates to be able to ease or to be able to raise capital. So that provided a very important psychological backstop for the market. And how we think about portfolio construction and from the perspective of 42 Macro is when the Fed comes out and you're in a market sell-off, you're in a crash, you're in a deep correction that's associated with a negative macro regime. When the Fed comes out and does something different, you need to do something different in your portfolio, because what the Fed is effectively doing from the perspective of market participants, it's pulling forward the next macro regime. Right now, the Fed says, okay, I acknowledge things are bad, but let me give you some goodies, and then those goodies allow you to start to think about and anticipate the next macro regime. And obviously, from that deep point of deflation in the spring of 2020, it became a situation where you could only reflate from there. It was pretty clear, to my models that by the month of May, we were going to already start reflating and accelerating off those April shutdown lows. And obviously, we've done nothing but continue to accelerate since then.
Oh, yeah, it's been insane. I mean, anyone that says there's no inflation isn't looking at asset class prices, are they?
No, I mean, I sincerely hope you're not communicating with people who don't think there's no inflation at this time. They're definitely, this is one of the most historic reflation periods in history.
Yeah.
When you talk about the year-over-year point-to-point returns in something like the stock market or the CRB index or the commodities index, I mean, these are some of the most historic year-over-year price changes ever. You're looking at March on March, and obviously, early April on early April. We've never seen. It's rare we've seen things like this. So the reality is, you got to go back to like early '09, or sorry, early 2010 when you're comping against the lows of '09 to see similar price action. It's actually quite similar setup. If you recall, the entire world was in a deflationary macro regime and obviously market regime from the late '07 all the way through the early part of 2009. And from that point, you had a period of simultaneous reflation, both from a macro regime perspective, i.e. what the economy is doing, and the markets were also pricing that in. So the market regime was saying, yes, I agree with that reflation that I'm seeing in the economy. And that's very similar to what we've seen over the last year, both out of the U.S. economies and global economies. At 42 Macro, we measure and map rate of change statistics for every economy, every OECD economy in the world. So it's about 38 or 40 of those economies, and if they're all basically saying the same thing, which we bottomed in March or April last year, and we've been reflating since.
And now looking ahead, how many good quarters have we got left? Because one of the things I know that some investors are looking at is the comps based on, or the COVID comp, basically, when you're coming out in areas like air travel or anything that's pretty much non-tech. So you've got retail reopening, and they're comparing against a complete shutdown. So you've got this huge rate of change on the numbers for public companies coming out with earnings. But then what happens after that? So how much of that great runway have we got left before everything theoretically implodes and we don't have such great comps because everything's accelerating and we end up in a deflationary period?
That's a phenomenal question, sir. You're very good at this. And so for some of your viewers, I'm not sure what the spectrum is on Acumen, but let me take a step back and kind of define what it is that you sort of are asking about. What you're talking about is the comparative base effect for different segments of the economy. So when you're calculating year-over-year growth statistics, you're obviously comparing against something that happened a year ago, or any percentage change calculation. There obviously has to be a comparative base to grow from and to calculate percentage change from. So what you're saying is the comps are very easy. The base effects are very easy, i.e. you have very depressed levels of activity and very depressed levels of growth and inflation in the March, April, May period of last year. And so what that's doing is, because of the comparative base is so low, the change off of that comparative base is actually incredibly high, and it's producing very high year-over-year percentage change statistics for both growth and inflation. And so we're obviously observing that, with the exception of, I would say last week was kind of a departure from what had been a sequence of uniformly accelerating and very, very high positive year-over-year rate of change statistics in both growth and inflation, not just for the U.S., but this is happening broadly. Every economy is on some version of the same cycle, with the exception of China. China went into COVID first, came out of COVID first, and because its base effects, its trough base effects, i.e. the period where it was lapping its shutdown, that occurred in February. And so February was the peak year-over-year rate of change growth for most of Chinese high-frequency economic statistics. March, you're starting to see, you saw some follow through in March, particularly the March trade data, but the reality is China's already peaked from a year-over-year rate of change perspective. And so to answer your question, what you're really looking at is, when does the rest of the world peak from a year-over-year rate of change perspective? And more importantly, when does the asset market start to look and price that in? And that, to me, that's the $64,000 question, and a question that you don't necessarily have to answer today. I think if you construct a portfolio in a very thoughtful, forward-looking way, you're gonna naturally nail that transition anyway. And what I mean by this is, some percentage of your portfolio has to be allocated to the current market regime. The current market regime is very clearly reflation. I mean, you have to have your head buried in the sand. You have to have your head buried in the trash can that is buried in the sand to not realize we're in reflation.
So are we not saying that inflation is transitory?
Well, everything is transitory, right? We're talking about rate of change. Yeah. That's the beauty of rate of change and using calculus as the fundamental principle by which we analyze economies and markets. It's all just a rate of change time series. Where are you on this time series that matters to asset markets? And so, right now it's almost like you're riding a roller coaster, and you're getting to that part of the sine curve where the third derivative is now negative, and you're worried about the negative second derivative as well. So in terms of our models, our forecasting tools, we have July being the month where we go negative on a second derivative perspective. In fact, April is the month where the data should peak, but from a trending perspective, it's likely to be that July is the first month where the trend is showing deceleration. And that matters to asset markets because the trend, oh, go ahead.
So when you say trend, are you talking about the trend in the rate of change peaking, or
the trend in the rate of change? So let's call it the 3-month delta on year-over-year growth, so the 3-month delta on inflation. So the 3-month delta on year-over-year growth will turn positive or turn negative in July. I.e., when you look back 3 months from July, the year-over-year growth number will be higher than the one that you're observing in July. So it's as simple as that. So what we're looking for is trying to spot when does the market say, okay, the trend has changed. Because there's a lot of noise in high frequency economic data, even low frequency economic data. You have obviously COVID is an exogenous event times a million. You obviously have exogenous events pulling the time series in different directions, but what the market really cares about is the trending rate of change of growth and inflation, and more importantly, how those trending rates of change influence policymakers.
So if we're talking about a peak for rate of change numbers in July of this year, July 2021.
Let me clarify. The trend should inflect negative in July.
Inflect negative. So we're talking about April numbers coming out in July, and we're having a negative inflection.
No. More specifically, the July data will demonstrate a decelerating trend from the trailing 3-month period or the trailing 6-month period. That's the month where I think the market will say we are no longer trending higher in growth. We are no longer trending higher in inflation. We are now trending lower from the perspective of the peak rate of change data we're going to observe in April for growth and in May for inflation.
And would you say that after July, there's a high probability of entering a deflationary period?
Yeah, absolutely. Very high probability. And more importantly, not only is it a high probability, it's one that should persist. I mean, if you look at the U.S. economy in particular, it's very likely that we're in what our framework calls deflation. That's where both growth and inflation are decelerating at the same time on a trending basis. It's very likely that we stay in that regime all the way through the late fall, early part, or all the way through the early part of the winter. And so to me, that is it's almost like a reversal of what we've seen over the last year. And so to me, that's super important. Now, historically, I would say that is very negative. That's incredible. That's about as negative as it gets. I mean, when you talk about back testing the sequence from going from reflation, which is growth up, inflation up on a trending basis, to growth down, inflation down on a trending basis, that's yelling fire in a crowded movie theater from the perspective of risk asset back tests. People are trying to get out of positions, they're scrambling to get into more defense, more safety trades. And so historically, that has caused a lot of consternation and volatility in asset markets. Now, this time might be different. And I hate using that phrase. It's a very dangerous phrase in our industry because there's nothing new under the sun. We're all doing some version of the same math and looking at the same publicly available statistics. And what I mean by it is the Fed is there is something different this time. The Fed's reaction function is incredibly different. And if you have not acknowledged that as an investor, you have not made enough money, or you've not made as much money as you should have in this inflation regime. So that's number one.
Oh, absolutely. I'm kicking myself for not getting straight back in April. I sat out on the sidelines and just watched the value of my cash erode until I finally realized, hang on a second, I can't afford to be out of this market with what's
Totally. I mean, obviously we're having a little sniffle today, but the reality is like you can stomach these sniffles if you know we have more scope to continue reflating. And the reason I believe we have more scope to continue reflating is really twofold. One, the Fed has already told you they're not going to tighten preemptively. Historically speaking, and the most recent example of this is Q4 2018. You go back to October in 18, the Fed J Powell is, we're a long ways away from neutral, yada, yada, yada. And by the way, that was very similar setup to what we had today economically. We had been a series of reflation for really almost 2 years in the U.S. economy. In fact, it was 9 of 10 quarters in the U.S. economy were reflating, growth up, inflation up on a trending basis. That was the longest uninterrupted streak of reflation in U.S. economic history. And so that first deceleration into deflation from that peak coincided with J Powell making what he thought was an innocuous comment, but was taken and interpreted as a rhetorical tightening by asset markets. We don't have a risk of that occurring today. Now, we will eventually get to the point where the Fed is talking about tapering and having a very serious discussion about that. But I think, if you think about what happened last Friday with the jobs report and the, I guess, disappointing trend higher in growth and the disappointing recovery in the labor market, I mean, we're obviously moving in the wrong direction on unemployment and things of that nature. The Fed, you could have made the case to the Fed by June, based on all the information we had prior to that jobs report, would maybe even start to have that conversation about tapering. I think June is definitely off the table now. They're not going to start talking about tapering in June unless we see something gangbusters in May from a labor market perspective, which obviously predate the June 16th Fed meeting. So I think it just what I'm really trying to say in so many words is we now have more scope to continue inflating. That rate of change slowdown in the economy from reflation to deflation is unlikely to be met with a policy error by the Fed, which insulates downside and risk assets and means you can probably stay in it to win it for a little bit longer than you otherwise would have.
So at what point do you think the market is going to start to front run any changes from the Fed?
Mm-hmm. Yeah, that's a great question. I mean, the reality is the Fed is clearly taking its cues from the labor market. And so there's the best way you can do that as from an investor perspective is front run material deltas in the labor market. Now that's that's way easier said than done. I mean, anybody who's sat in my seat or has built any econometric models knows that forecasting the jobs report is that's a carnival game more than anything. It's a carnival game more than it is an actual econometric exercise. But the reality is, I think you can start to, if you start to piece these things together, you don't have to actually nail it, pin the tail on the donkey that, this print's got to be 2 million plus jobs, and this print we're going to see average hourly earnings actually go up. I don't think you need to do that. I think you need to listen to the market. The market will tell you where the labor market is going. And right now, the market is telling you from the perspective of real interest rates, which are now neutral in my model. They have been just bullish for months, obviously, from the perspective of the volatility adjusted momentum signal that we use here at 42 Macro. They're now neutral. And so the market is now starting to tell you, hey, like this material positive delta in employment and in wages isn't a near-term thing. The recovery in the labor market might be delayed and actually take longer to heal. And one of the reasons for that, if you think about the enhanced unemployment insurance scheme in the U.S., it's our you guys have labor market insurance as well. When someone loses their job, they get benefits from the state. So we have a similar program here in the U.S., and they're currently receiving an additional $300 a week of benefits. So you're getting $1,200 a month on top of what you would already be receiving. And so a lot of folks are sitting at home saying, why in the heck would I, maybe I'm vaccinated, maybe I'm not vaccinated, but why in the hell would I risk my life and or my own happiness and go back to work when I can just sit here and collect money from Uncle Sam all the way through September? And that to me is a real governor on the recovery in the labor market, which keeps the Fed in play from the perspective of risk assets.
So is there a risk of, I guess it's not so much a risk to investors, it's more of a risk to the probability of a deflationary period in Q3? Is there a risk as a result of people not going back to work and this kind of these low numbers in the labor market continuing through to Q3 and Q4 potentially? Mm-hmm. Because at the end of the day, it's not just about, personally, I don't think it's just about fear of corona. If you're earning an extra $1,200 a month plus, and you're not having to travel to work and you can sit at home and do whatever the hell you want, then what's the point? It comes down to not being paid enough, which the majority of these jobs that were lost as a result of corona weren't high paying jobs. No, anyone that was working in tech or in white collar jobs has continued to work throughout. They've just been working from home.
Yeah, probably made more money. And if the government was handing out checks to business owners saying, hey, take our money, I think most white collar folks are probably richer than they ever been. Thanks to
yeah, I mean, combine that with the inflation in asset prices, I'm sure.
Yeah, totally. So, I mean, yeah, I completely agree. And to me, that this is where the rubber meets the road on portfolio construction. We know we're in this reflationary market regime currently, so we need to be allocated according to what the market's giving. It's like football. You take what the defense is giving you. Don't just throw the ball in a triple coverage. Or I'm sure you guys like football is soccer for you guys. Or soccer for us is football for you guys. So you don't just kick the ball into three different people, right? You want to hit open people. And so it's the same concept of football. It's all spatial awareness, and the spatial awareness associated with our process says I don't want to put on a mega deflation portfolio until the market tells me to put on a mega deflation portfolio. But I also don't want to not have some of it on, because when the market moves to put it on, the big moves happen at the beginning of the transition. You know, when the market goes from, you know, full bore reflation to saying, okay, I'm ready to go deflation, I guarantee you the 10-year treasury will be down 20, 25 bips in like a 2-week period. And if you don't have some exposure to, let's say, the long end of the treasury curve here, then in my opinion, you're not doing this right. You're too overly allocated to something that is in its later innings, as opposed to being aware of the, you know, potential transition. So this is how we put it all together. It's okay. We know we got inflation. How much do we need to be in inflation? What's the residual that we can allocate to deflation in anticipation of that rollover? It may not come, right? If the rollover never comes, then we don't have to, you know, get fully out of the inflation aspect of what we're doing. And in fact, we can start to pivot back if the nowcast and the forecast change. I don't expect they're going to change. I mean, we're talking about lapping a shutdown economically in April and lapping an open economy in June, July, and August. You're going to see a deceleration in growth and inflation now, because deceleration in inflation is a bit different. Inflation is likely to stay much more sticky, i.e., it'll stay the inflation statistics across most of the economies that we model will stay near their cycle peak for much longer than the growth statistics will. The growth statistics look like an inverted V in terms of getting you down to a more normalized growth rate by the middle of the year, whereas the inflation statistics look much like a U process. You know, they'll peak in May, some June, depending on the economy, but the reality of the decel is not going to be very sharp there. And so that's another thing. You're going to have sticky inflation with decelerating growth with the Fed that's, you know, probably not doing a whole heck of a lot. So from the perspective of an investor, you don't necessarily have to do a whole heck of a lot with that as it relates to where we currently stand today.
When we talk about having a deflationary portfolio, where would you be allocating in that kind of environment?
Yeah, so I mean, there's a number of things that would do well in a deflation market regime. Obviously, the treasury bonds, German bonds, Japanese government bonds, Swiss government bonds, you know, those types of exposures. Gold is a very, very positive exposure in deflation. And then when you think about within the equity risk that you're taking, it's high grade, and equity and credit risk that you're taking. You're high grading the portfolio. You're going to lower beta securities in expensive high beta. You're going to larger cap as inexpensive small cap. You're certainly coming up the credit spectrum as opposed to, you know, going down the credit spectrum. So there will be some moves to be made if and when the market regime goes from inflation to deflation. Right now, the market regime is still saying we're in inflation. You don't have to be overly allocated to deflation. And this is what I think is missing from macro. People have these very well-researched, thoughtful views. I mean, there's some brilliant people out there giving away some very awesome research for free, I might add. But the reality is, how much of that do I need in my portfolio as an investor? You know, as an institutional or personal investor. If you have this long-term deflationary Lacey Hunt type view, or if you have this long-term inflationary Jim Bianco type view, how do I merge those two things? Do I just be all in one or all in the other? I think that's a very dangerous thing to do as an investor, because it requires you to have a lot of forecasting precision on something that's, one, very far out in time, and two, something that people have not historically had a lot of forecasting precision on. You know, the reality is, okay, how do I construct to get the best of from each of these views into my portfolio to make my portfolio weatherproof to these sort of cyclical and secular dynamics?
Okay, so just focusing on one of the things that you said, which was kind of, I guess, pertinent to me, was moving away from the expensive small cap. And one of the questions I had in the back of my mind is, do you think that the rate of change of growth on an individual stock will outperform? So let's say we've got a highly positive rate of change of growth of an individual stock. It's one that you like, you have a long-term view on it. Is that going to, you know, if it's a small cap and it doesn't traditionally perform well in a deflationary period, will the rate of change on the company's reports, on its earnings reports, beat out the deflationary period?
I think so. And the reason I say that is because of the lessons we learned last spring. If you go back to last spring, you know, I was obviously still at Hedgeye at the time. So, you know, the Hedgeye, myself included, we're making a quad 4 call, what they call quad 4. That's where growth and inflation are decelerating at the same time. Historically speaking, that's been very negative for tech and growth as a sector and as a style factor within the U.S. equity market. Well, that's not what happened from a relative return perspective. Tech outperformed, and the reason it outperformed is what we subsequently learned. There was a pull forward of demand, a historic pull forward of demand in the work from home economy, in these software services and in those types of names. So, my interpretation from learning from that lesson, which is to say, if companies, particularly in the consumer services space, you think about cruise liners are obvious, hotels are obvious, it's going to be less obvious suppliers of those types of companies, the people who wash the sheets at the hotel, things like that. There's going to be knock-on effects. But the reality is companies that are showing accelerating momentum in their revenues and their cash flows and their earnings always get a premium multiple relative to their peer group. That has not changed. Now, whether or not they survive the scrutiny of an absolute positive return is of the question. I suspect if we have a 10 to 15% correction in asset markets, sometime this summer, it's very unlikely you see positive returns, but it's very likely that you actually could outperform from a long short perspective, being long in those types of names relative to the types of names that are showing decelerating earnings and cash flows. And I think that's part of the reason why you're starting to see tech underperform today. I mean, tech has obviously been on an absolute tear, at least through the second half of March and all the way through April. But I think as we get closer to Q2 earnings season, when these companies are not lapping COVID comparisons, well, they're lapping COVID comparisons, but their COVID comparisons are very positive.
Yeah.
COVID was very, very kind to their businesses. So when they start to compare against those things, it could be actually quite negative from an expectation, from a beat miss expectations perspective. So that's something that'll be an issue could potentially be an issue for the market, just given the amount of concentration and market cap associated with those names. So you got to be on the lookout for that in July. All this could come to a head in July. I mean, for sure.
Yeah. So is that going to cause a much bigger problem though? Because we look at what happened with Bill Hwang, there's clear signs that there's a lot of money flowing around in markets and a lot of over-levered money in the same positions. There's a lot of crowded plays. Everyone's in Amazon, everyone's in Tesla, everyone's in Alphabet. Mm-hmm. When you have bad comps, after when they've got to compare to what was a great time. They had a roaring time over COVID because of that you described. It's not going to be that good. They've kind of used up. They've taken everyone in. Everyone that's working from home is working from home. There's no more of that. If anything, there's going to be a drag on demand. So you're going to have this deceleration in rate of change of earnings for these companies.
Yep.
Will that impact the wider market as a result of the fact that there are crowded trades?
Yeah, absolutely. I certainly think it will. I mean, that's the issue, right? You're going into a macro regime that is that is historically, from a backtest perspective, has proved unfavorable for that particular exposure. Now, whether or not the market regime transitions to pricing that macro regime in is anybody's guess. Most of the time it does, so we don't have to be too concerned about that. Certainly not ex ante. And so, let's talk about where we know what the world looks like today. Let's move forward a couple months, and we're in mid-July. And what does the world look like then? Well, we're now receiving economic data from June that now looks like we're starting to decelerate growth perspective. Where it's July, and the company, the whisper numbers coming out of companies will start to say, hey, we those types of companies in particular will say, hey, no, we couldn't comp to comp. It was actually quite difficult. And so the reality is, you could have a very different market narrative in that particular time frame, where things are no longer ubiquitously improving on a trending basis. The earnings are no longer being blown out of the water across sectors, across factors, and you actually have a go-forward outlook for things not only decelerating, but actually now starting to disappoint expectations. And that, to me, is a big shift relative to where we are today. Now, again, it's not as negative as a shift as we could see. But think about what we could potentially have had prior to Friday's jobs report. Let's say Friday's jobs report was 1.2 million as opposed to 200,000 or 260-some-thousand. The narrative, the risk to asset markets would be much greater in that time period that we're discussing now in July. You have a Fed that's potentially talking about tapering. You have fiscal policy that looks like it has less of a scope to get the size of these packages passed. I mean, right now they're talking about they're using emergency numbers when there's clearly like a decline in the belief that we're still in a crisis. So the likelihood that they could get very large fiscal programs passed if the economy is in a much better position from a levels perspective is lower. And so you start to you haircut fiscal policy expectations. You start to take up or pull forward tapering expectations. At the same time, all this is going on from the perspective of company earnings and updates in July. So that would have been a really bad situation for the market. I mean, that's where you could see easily from these levels of a 10, 20, maybe even 30% decline in asset markets, because again, you're talking about yelling fire in a crowded movie theater. You have all these tailwinds right now that have been very positive. You have fiscal policy easing, you have monetary policy easing, you have growth accelerating, you have inflation accelerating, you have earnings accelerating. Those 5 things have only happened about 10 times since 1960 at the same time.
Wow.
And so, you're talking about potentially removing all 5 of them at once in July, but the reality is we're only going to remove about 2 or 3 of them now. So that's on the margin more bullish than it would have been, but it's still not bullish. And
could we be looking? You said 15, 20, maybe 30% decline. Could we
in the scenario where all 5 get taken away? Yeah.
Could we potentially be looking at something much deeper, similar to the global financial crisis, or?
No, it's unlikely. Well, yes. Here's the scenario where things are really bad. One, you take away all 5, but inflation gets to a very high level and stays at a very, really high level. That's where the Fed can no longer come out and effectively backstop the fiscal program. I mean, the Fed effectively, what they're doing, if you look at the change in the Fed's balance sheet relative to the change in the deficit, they're effectively monetizing the debt. They won't tell you that. They're obviously not inflated to tell you that, but that's what they're doing. So we can do math. That would have been a really negative scenario, because you got to layer on the fact that positioning obviously is incredibly asymmetrically skewed to the reflation trade. It's been on for nearly a year. Bits and pieces, the intermittent bouts of non-inflation, but for the most part, it's been on for a year. So the position is very skewed in we're betting on inflation from the market investor consensus perspective. So if you took away the punch bowl, every single punch bowl in every direction, you would have had a really negative market event. I don't think that's the case. I think the case is much more nuanced, and it'll be much more about buying the stocks, the sectors, the subsectors really that have positive accelerating momentum through the summertime, through the fall, being underweight those that don't, and more importantly, being underweight those that have historically underperformed in a deflation regime. That's obviously your cyclical higher beta component. So a lot of what's working now, you're going to have to get out of. So that's a potential headwind for the market as well. But again, you're not going to get a 15, 20% decline in asset markets unless the Fed does something different that is deleterious to the liquidity profile of asset markets. And it's unlikely, certainly not in the next 3 to 4 months, that they do something very different. I think there's a lot more progress that needs to be made from the perspective of the labor market before they could really even seriously entertain the discussions. I would have thought they'd be entertaining discussions by July, certainly openly and honestly by July. But the reality is it's probably not the case, or at least for now.
Do you think that progress is even possible whilst the unemployment benefits remain as high as they are?
I think we're learning that is the key question to ask. I'd be remiss to pretend like I have an answer to that, because I don't think anybody does. But I think we can speculate, and the reality is when you look at the labor report, it's looking like it's a problem.
Yeah,
it looks like an issue. And we knew it would be an issue. You saw the NFIB, the National Federation for Independent Business, maybe, or NFIB. They published the Small Business Optimism Index, and one of the subcomponents in the index is the job openings hard to fill. And I believe in February that hit an all-time high. Like, if people were just finding it difficult to hire and find and retain workers because of a variety of factors, but the most obvious factor, from my perspective, is the fact that we're giving people $1,200 a month to stay at home. That's a lot of money.
Yeah. Absolutely. Now, pulling away from the US a bit, you mentioned earlier that China is already in a deflationary period. How does Europe look as well? Because they don't have necessarily, they're not looking at this jobs report in the same way, or is it all intertwined? Are we dependent on the US? If there's huge liquidity and a raging bull market in the US, is Europe going to follow it? Or at what point do we kind of pivot away from that growth period?
No, that's a phenomenal question, and so I'll start the answer by saying the world has been very harmoniously synchronized in inflation. I mean, over 90% of economies that we model, these are all the OECD economies and the additional, the major economies that they track as well. So it's about 38 total in the model. Over 90% of them have been in inflation for really the past year. With intermittent bouts here and there, pick your economy, like the U.S., for instance, was in Goldilocks. That's where growth's accelerating, inflation's decelerating in November and December. But the reality is the whole table's lit up green. Reflation. Now we're going to start to see some divergences and a lot more sort of volatility in the macro regimes that we've seen in recent months and quarters. And, so if you think about China and Europe in particular, China's already in what we call inflation. Inflation is where inflation is accelerating on a trending basis, but growth is decelerating on a trending basis. China's been in that regime since April, and is likely to remain in that regime well through the summertime. Europe is likely to transition into that regime starting in June. I could be amenable to that, potentially having some forecast error there, and maybe that starts in July as well. But the reality is, the world is now starting to diverge. The U.S. looks like its inflation cycle is peaking, whereas the rest of the world, its inflation cycle will continue to accelerate, likely into the third and fourth quarter.
So do you think that the rest of the world is going to see this deflationary quad 4 environment in Q4 of this year?
In Q4 of this year, let me double check that answer. I think the transition is usually the point of pain for asset markets. Yeah. It's going from something where everyone's sitting on one side of the boat and you got to get to the other side of the boat. That's the problem for asset markets. If you're talking about everybody being in deflation, i.e., by Q4 of this year, I would anticipate that the market has a problem with that at some point during that transition process. That's where the friction happens in asset markets. And so, to me, I think that the most relevant point in time that investors should be laser focused on global. I'll start with global equities. Having that friction moment is June through August. June through August is where you're going to go from everything is fine and things are getting better to by the end of August, it's very clearly decelerating. And so to me, there's a friction point in there where asset markets have to start to price something in different from a macro regime perspective. That window from the perspective of the U.S. economy is in July through August, September. And the reason I say August, September is because, again, the labor market recovery might be elongated and actually might take longer, which delays a legitimate discussion about the timing of tapering at the FOMC.
Yeah. It's scary to think about.
I disagree, Hamilton. No. I don't think it's scary. I think it's a huge opportunity for investors who are aware of all these dynamics. I think if you benefited from the reflation trade, you're going to be looking to book gains anyway. Everybody should be aware that we are in a historic period of reflation across asset markets.
I mean,
this is not normal.
Scary is the mindset of the people that I see, especially on FinTwit or the Reddit.
Dogecoin is not normal. This is not normal.
But I'm seeing it throughout my daily life now because, obviously I deal with a lot of people in finance who are a lot more aware and like, this is crazy. Markets can't keep going up forever. But then you hear the people on the street, the cab drivers, the builders all talking about, oh, markets only go up. I'm up 10x on this cryptocurrency.
Yeah.
That's the scary thing. These people have no experience and potentially going to be blindsided by this shift.
Yeah, well, people don't understand that liquidity. You take the elevator, or you take the stairs up in asset markets, and you take the elevator down.
Absolutely.
Most of the investors who are particularly in the more speculative pockets of the market, and I would include crypto in that. I'm a big believer in crypto, but it's obviously very speculative. You think about like SPACs have obviously derated, but even the Cathie Wood stocks have derated. But even you look at something like corn, for instance, which obviously is crypto speculation associated with it. All these speculative parts of the market have taken the stairs up and some degree, maybe an escalator, running up an escalator. But I think a lot of investors who allocated funds to these exposures, this is the first time they've allocated funds to any exposure. They've never been through the washout process. They've never seen what liquidity looks like on the bid ask when they're trying to get out with everybody else. That to me is the big issue with asset markets right now, is that you have a lot of investors who have made a lot of money, and they, a lot of millennial investors in particular, weren't invested in risk assets, weren't invested in stocks or even crypto, and bought a lot of both at the March lows of last year, or said, hey, I got $10,000 or $5,000, and here's let me buy some crypto, let me buy some stocks, and they've been rewarded for that view. They were the liquidity provider for the broader markets in that juncture, particularly around that Fed pivot we discussed. Now they're going to go through their first regime transition. They haven't even had a macro regime transition. It's just been reflation for the most part since then.
Yeah.
What happens when they're not, every time they buy something, it doesn't go straight up. It actually starts to have mark-to-market losses, or they start to eat into their profits, and they start to say, hey, man, this doesn't feel good. I think we kind of saw a preview of what that looks like with the Cathie Wood stocks and with your SPACs and things like that. And so the reality is, when that starts to happen broadly, that's where you get the friction in asset markets, because there is no liquidity provider, right? Like if you people are selling, institutions are rebalancing, and you got every class of investor sort of making the same sort of high grade your portfolio view, lower beta, higher grade in credit rating, higher cap in market cap, lower debt, lower leverage to the economy, things like that. If everyone's making a very similar portfolio transition at the same time, you're gonna have a problem.
Yeah. Like one of the biggest risks out there is certainly in the more small cap or meme stocks that have run up, the AMCs of the world, that have been run up by retail money, and people aren't really looking at the volume of inflow that's driving up these prices. When you have this rug pull on the market and regime change and liquidity dries up and there's no more money going in, you're talking about 80-90% decline in some stocks potentially, because they've only been, they've run up 10-20.
Totally. What's the valuation support for all this stuff? Seriously, it's when something's doubled twice in 6 months, there's no valuation support. There's no real legitimate conversation about where the appropriate valuation is. There are no valuation buyers. Who is the buyer of the first tip down in inflation once the regime changes? We're all here. You had to have been in a coma to miss this inflation trade. And so unless the goal is the hope in the market is that we hope a bunch of very wealthy investors wake up and buy reflation in July, that's obviously unlikely to happen. It could be messy. And again, let me be very clear about this. It's not going to be as messy as it could have been. The Fed taking away the punch bowl right when we were likely to transition from an economic perspective would have been a disaster, just an absolute unmitigated disaster from these levels, from these valuations, from this sentiment and position. It's going to be something in the direction of a disaster, but just much less. I would expect, and again, I think it's stupid to make prognostications on the S&P will be down 10 to 12% or yada yada yada. So I'm not going to go there. But the reality is, you're going to want to have the exposure in your portfolio is whatever is currently allocated to reflation. You're going to want to start to systematically shrink that as we get closer and closer to these dates, and systematically expand the amount of higher grade, higher quality exposures you have across the key asset classes into that process. So that's kind of what we do at 42 Macro.
And what gets us out of this deflationary regime?
Time is the most important factor in economics. You just got to roll forward on the x-axis till you get to a different regime. Simple as that. I mean, the Fed, like going back to last March, the Fed can pull forward time. Like when you're in a deep deflation regime and the Fed does something as aggressive as open-ended QE and all sorts of brand new alphabet soup liquidity programs, they're pulling forward that time process. Like they're grabbing the x-axis and they're pulling it forward and saying, hey, you're now in this new regime, go play.
But is that just delaying the inevitable and making things even worse down the line? Because doesn't somebody have to pay this back ultimately?
Yes and no. I mean, like that, you can make until the regime of people believe central bankers, or more importantly, are too afraid to actually fight them for real. Until that changes, no, there's no need to pay it back, right? It's all sitting on the Fed's balance sheet. It's all sitting on the BOJ's balance sheet. Their goal is, I think, a secondary byproduct and a positive, byproduct of what they're trying to accomplish is, getting asset markets up, because asset markets increasing obviously increases the liquidity, the sort of liquidity spigot in the economy, and you get, credit intermediation. I think their primary goal is to make sure that the fiscal authorities are solvent.
Yeah.
I mean, that's clearly what they're engaged in. They're not going to ever say that out loud. That would you'd have the Austrians and the Hayekians up in arms, the von Mises Institute, marching down the street, storming the Capitol. They're not going to say that.
That's already happened, hasn't it?
Yeah, totally. I don't know if those folks are von Mises Institute. I haven't seen them on the chat rooms, but in the discussion boards. So to answer your question is, I don't think we're going to get to the point, certainly not over any forecastable horizon that I can see, where the market says all the money's due. You now have to pay this bill. I think what's more likely to happen is we're frogs boiled in a pot of water, and you and I are dead or retired by the time the pot boils over. That's what's more likely to happen. It's a lot easier for me to sell you a narrative about how everything's about to change, because that gets you clicks, that gets you eyeballs. But the reality is, unless you have some real specific catalyst that will cause that change, there's no point in anticipating it, because it's not going to come to fruition over an investable time horizon.
Yeah.
Awesome. I got to wrap pretty soon. I got 3 o'clock.
Oh yeah, no, it's been a pleasure. One more question for you though, Darius. So time is going to be the thing that switches back out of this deflationary period, and then we come back in, and you think, I don't know how. Do you have an estimate on how long that lasts? Is part of the question, and the other question is, where do you see the opportunities for people that get out ahead of this?
Yeah. So by the end of Q1 of next year, the U.S. economy is likely to transition into Goldilocks. I suspect by the beginning of next year, you could actually see asset markets start to move to price that in. But the reality is when you're in deflation, the market declines markets are elevator or stairs up, elevator or window down, elevator up, window down. Always remember that. So if you're having a decline in asset markets that's associated with that transition, it should occur at the beginning part of that. Now, the other side of that decline, you still might want to remain in a higher graded, higher cap, lower beta, lower leverage sort of set asset mix, because getting through the soup is still not necessarily positive. But if you're talking about actually hedging for downside risk, you would expect that to occur during the transition.
Yeah. Okay. Awesome. Darius, thank you so much for coming on, man. It's been an absolute pleasure, and it's so great to meet you after watching you from afar for all this time.
Yeah, likewise, man. This is awesome. We'll do it again soon.
Thank you, Darius. Thank you so much. I'll let you know when it's out, and have a great time, and I hope everything turns out all right for you. I'm rooting for you.
Yeah, appreciate that, man.
Macro 42. Man.
Yeah, thank you, brother. I appreciate you, man.
Take it easy, Darius. Thank you.
You too. Cheers.
Okay guys, I hope you enjoyed that as much as I did. It was such a privilege to have someone of that caliber come and talk on this channel. So huge thank you to Darius for taking the time. Please make sure to smash that like button. It helps grow this channel so that we can get more people like Darius sharing quality investing insights. And don't forget to check out 42macro.com for insanely good investing research. Darius is the best of the best at what he does. Subscribe to the channel and turn on notifications. That's all from me, and that's a wrap.